Hey, how's it going, guys? Welcome back to the Capital Mindset Show. So today's going to be an interesting how-to video on how to destroy shareholder value. A little bit satirical, I know, but it actually comes off the back of recent news, actually more like last week, on Tesla whale calling for a $15 billion buyback. And I thought I'd give my thoughts and a little bit of kind of a quasi case study on this. But essentially, this individual, and I think what's this guy's name? I always forget his name. Leo Kuguan. Okay, so we're going to just call him Leo. And Leo is suggesting that Tesla should do a $15 billion buyback split off between $5 billion and $10 billion. Now, I just want to start off that Tesla hasn't announced a buyback. So I'm not saying that Tesla right now is doing something that is quote unquote bad. All right, but we are talking about the prospects of it. And then we're going to kind of compare to kind of how academically we can look at buybacks and what are the ways in which we can judge buybacks in a good way or in a negative way. Okay, so first off, I'll just say, what are buybacks, right? So for those of you who may not know, buybacks simply are the company deleting the shares, buying back the shares from in the open market from, let's say maybe you, I, whoever is selling the shares at any given time, and they repurchase those shares and basically they're gone. For all intents and purposes, for what you have to know, they're gone. And the remaining shareholders own more of the economic profits at the end of the day. Okay, so that's the good news about buybacks. That's a good thing about buybacks. When you think about it, buybacks reward those who kind of want to stick with the company for a long period of time with greater ownership, and at the same time compensates those who are trying to sell off their shares. Okay, so where can buybacks be a negative, right? Well, buybacks, in essence, they bring out new demand for said stock. So we talked about the mechanisms. This is kind of getting back into the olden days of capital mindset. We've talked about the mechanisms for what causes stocks to go up and down over the short period of time, and that has to do with the supply and demand dynamics that exist in almost everything. Well, in the stock market, it's there as well. If more people are trying to buy shares of a stock than sell it, then the price would go up. Now, if we kind of consider a buyback for a moment, a buyback is demand but stemming from the company. Now, the company is using cash, right? Whose cash is this? A lot of people will answer this question and say, well, it's the company's cash. Wrong. No, it's your cash as a shareholder, right? The management has designated that cash be used to repurchase shares. So they are using your cash. It is a way, that's why we call it capital return. It is a form of return to shareholders. Okay, so there's two forms that a company can return cash to shareholders. That is in the form of dividends, which is a cash payment to your account. And then the other form is a buyback. A buyback is an indirect method, but basically, in essence, what it does is it purchases the shares that people are trying to sell. So you could think of it in two ways. It increases your economic ownership of the future value of said shares into the future. Okay, so you will own more of those future dollars than previously thought. Or you could think of it as when you're trying to sell some of your shares, you're basically selling back to the company. And in that way, you're kind of getting the shares or the cash. There's no real way of knowing whether or not you sold to the company or you sold to some random guy. Okay, so just be aware of that. Now, what are some of the issues that might arise? Well, we take a look at this. So I took us here to Apple's balance sheet. Now I'll actually zoom in a little bit. So I'll try to get out of the way when I want to talk about something. But basically, in essence, we want to take a look at this. So cash and cash equivalents, right, and marketable securities. So in the current asset portion, the company will utilize this, hopefully, and typically maybe for cash from operations as well. So cash is coming in, and the cash they have on the books, they're going to use that cash to purchase shares, okay, or repurchase shares. So in that sense, you think of the balance sheet as this, quite literally the name balance sheet. So assets and must balance with liabilities and equity. So shareholders' equity down here. So remember that calculation return on equity? Well, we'll get back to that in a second. But let's think of it like this. So you reduce the cash portion of the balance sheet, and what you can do is take that cash that you're reducing, because what are you going to spend it on? Well, let's say you spend it on repurchase of shares. So we go to the statement of cash flows, and you will see a repurchase of common stock right here, this line item right there. So they spent $85 billion repurchasing common stock in this 10K report. Okay, so that's according to this 10K report. They spent $85.971 billion repurchasing shares. Okay, so that cash goes away. All right, let's leave all else equal. All else equal, cash goes away. We won't worry about the numbers. We're just going to worry about the bird's eye view of things. So cash goes away. All right, you have less cash now. Now in the balance sheet, we have to balance things, okay? Trying to make it basic, but we're trying to balance things. So again, assets up here must balance with liabilities and shareholders' equity. So these two should add up together, okay? So if cash is being reduced, what on this side is being reduced, okay? Well, one thing could happen, okay? So we could, right? Well, should I just tell you? I'll just tell you. So we could equity would come down in that sense. So actually, you can read into this further, but I'm just kind of maybe hopefully introducing this to some of you that share buybacks can in fact increase artificially return on equity. So ROE can actually be benefited by share buybacks, which is unfortunate because a lot of management teams are actually incentivized to do so because their pay structures are such. So then they are incentivized to do buybacks because buybacks can reduce increase ROE by reducing equity. So equity being part of the formula, which I'll show you guys here. It's probably one of the more easy ratios to calculate. ROE is net income divided by shareholders' equity. And so in math, we learned that if you reduce the denominator, you actually end up with a bigger number if the net income remains the same. So example, if originally this is 5 and this is 10, then you have ROE of 50%. All right, now change it up. Now make this 5 because we reduced it all the way down to 5, but net income remains the same. 5 and 5, you get 100%. Okay, so we can make the ROE larger if we reduce shareholders' equity. One way of doing that is through share buybacks because we can reduce the asset portion of the balance sheet, and that reflects itself in the shareholders' equity. All else making liabilities equal. Okay, so if liabilities, stay the same, everything else stays the same. There you go. Now things can get worse for you if you take on debt to repurchase shares, and then we have a kind of so in that instance, we would actually be increasing the portion of the liability section and then decreasing the portion of the stockholders' equity. And then the assets would remain unchanged in that sense. So all else being equal, so be very careful with my words there, all else being equal, if Apple were to not use any of its cash from operations or its cash on hand to do this, and it just increases its debt portion to then repurchase shares, then we would increase the liabilities portion and decrease the shareholders' equity portion. We would get the same effect in essence from the ROE formula, but we would be worse off technically on a broader, when you actually look at it deeper, you'd be worse off because you're taking on liabilities, right? Liabilities that must be paid for in the future. Also, you're increasing other forms of expense, etc. But that's kind of a bird's eye view. All right, so what do we say about this? Okay, so Tesla calls for $15 billion stock. So let's actually take a look at Tesla stock. Okay, so Tesla stock, what is the market cap currently? $687 billion. I've stated this when they were at $1 trillion. And you want to go check out the discussion I had with a Tesla bull. It's on the channel. And in that video, I did mention at one point that I think Tesla should be diluting shares. I mentioned it also in my Tesla analysis video, that Tesla should be diluting shares. Why? Why would you say such a thing? Well, if you actually think about it, if Tesla were to issue shares, let's say when it was at $1 trillion, every 1% dilution rate is a $10 billion cash raise. So if they were to dilute maybe, let's say 2%, which seems actually very little, and actually that's very little compared to a lot of companies, then that in that instance, they would raise about $20 billion in capital, which think about how many production facilities Tesla could do. So everything is about the nuance of the situation. What situation is the company in? Now, I know that there's a larger YouTuber, which I'm working really hard against to kind of dispel this information because they actually made a lot of people feel this way. And it's really unfortunate because it's very much wrong. But someone out there, and I'll let you use your imagination as to who, said that when a company is profitable, I don't see why they would dilute shares or why they would issue new shares. Well, that person is very silly. So don't listen to that person because that person doesn't understand what the premise of being a management team means, okay? What you want to do is reduce the cost of capital so that you can engage in more and more value accretive projects. So in this instance, we're looking at Tesla. So Tesla is profitable already. Does it mean that they won't dilute into the future? No, it all depends because equity or issuing shares is a cost is a form of cost of capital, right? So when I issue shares, the implicit cost is the loss of those economic benefits of those shares, the dilution factor. So if we dilute shares, of course, the shares and the earnings that they potentially will earn into the future is that implicit cost. Now, if I issue debt, the implicit cost is the interest rate. So if we're looking at Tesla, and if Tesla were to issue shares at about $1 trillion, okay, that cost will presumably be, depending on your perspective, be cheap or expensive. From my perspective, it's expensive. I think from Elon's perspective, based on his tweets in the past, it was expensive. So I think that Tesla would have been best served, and its shareholders longer term would have been best served if the company issues shares. And currently still, a 1% dilution rate is about $6.8 billion if they were to do it now. Of course, that's all else being equal and making the assumption they can do it immediately. It's not like that, but we say it'd be better off doing that than wasting about $15 billion in share buybacks at the present moment. Now, some of you might disagree with me there, and I'd love to hear your thoughts down below. Why do you think, if you disagree, that Tesla should be using its cash to buy back shares instead of investing into the business? Now, we're going to go onto the Hall of Fame of companies that have done terrible buybacks. So this is General Electric. You might have heard of General Electric. They've been doing buybacks for quite some time when they shouldn't have been, when they should have been fortifying their balance sheet, when they should have been investing in their businesses. So easier said than done, right? Invest in your businesses. You could always just burn money in that way by investing in fruitfulness endeavors. But, let's assume that you do have opportunities ahead of you. Well, in that instance, why aren't you investing in those opportunities? Why aren't you developing your business further? On one that we can point to more recently is Intel. So Intel was a stock that I did sell in the 50s. Many of you remember those days. And remember that what the disagreement I had with my own subscribers in the comments section. I stated that I didn't agree with Intel's capital allocation strategy. Now, Intel was buying back shares throughout this whole time period. Now, what's the problem with that? Well, they should have been. They obviously now should have been. The hindsight's 2020, but this was something that was obvious to me at the time. That's why I said I don't agree with their capital allocation strategy. They're acquiring capital from businesses and selling off businesses instead of what they should have been doing most of the time was not actually maybe issuing that dividend, right? They should be cutting that dividend, and they should be cutting that share repurchase agreement. So they already cut the repurchase, the share repurchases. I know that, but they should have been doing that in the past, and now they're going to reap what they sowed. Now they have to invest into their business, and they need to get cash from somewhere. The management still shows me that they don't want to stop paying the dividend, which is a hard choice. I know, but you have to make hard decisions in business. You have to do that for the longevity of the enterprise as a whole, not just for the short-termism of I don't want the stock price to go down because my compensation package relies on it. So then that's an unfortunate thing by the board that they've issued the compensation package as such, that the CEO is incentivized in perhaps the wrong direction. So now they're investing in the right things, but now you see that the way that they're getting that capital is going to be probably more costly than before. Okay, and look at this. Hindsight's 2020, I guess. But when I made that video about selling Intel and not agreeing with their sale of Mobileye, a lot of comments were saying that Mobileye would sell for a lot of money. I doubt so much in the current market, and that's why I did also state that you cannot pretend to time the market like that. So Intel was essentially trying to time it there. They should have sold it right then and there if they were going to do such a thing. Not say that they're going to sell it at the summer of this year, and I don't even know what price they're going to get now, but I can tell you it's not going to be that much compared to maybe last year during the liquidity boom. Now we're in the liquidity crunch. Not so good. All right, another one that we can actually point to is IBM. IBM, you guys probably heard of IBM, right? So IBM, under the last CEO, Ginny Rometty or whatever her name was, she was destroying the company. She was basically buying back shares, taking on debt to buy back shares. Absolutely horrendous. Absolutely horrendous. So instead of investing into the business and trying to make the business more efficient, she thought it would be better off to do financial engineering. And let me be very clear. Let's actually start talking good about buybacks. BRKA. So if buybacks are executed correctly, they can be superior to dividends. But then that's the caveat. That's the big asterisk, everyone. So the asterisk in that statement is if they're executed correctly. If they're executed poorly, then it's a great way to destroy shareholder wealth. It is a great way for the management team to increase their paycheck. So you got to be very careful with that. A good smell test that I like to implement in typically my analysis is if the company is doing buybacks right now, would I be buying those shares? If I would avoid those shares entirely and the company is buying back shares, I would probably sell off that stock because I would completely disagree with how management's investing the capital. Okay, I would not like that. Now, the thing is, Apple, let's actually talk about Apple because Apple's the big elephant in the room. When Buffett was buying Apple, Apple was extremely cheap. On almost every objective measure, by the way, because I remember back in those days, and well, I won't say anything else, but back in those days, Buffett was buying Apple. Apple was trading at let's say you use a simplistic measure of PE. PE was about 13, 12, 11, 15, around in that range. And nowhere close to where it was approaching recently, which was almost like 30. It was like 26. Now it's at like 22 according to Google. So yeah, we could say on an objective basis back then it was a cheaper company, and that's when the company began to start buying back shares. Now, here's the big caveat, and if you made it to this part of the video, this part's going to be more information, okay, yet more information, yet more things to consider, because Apple's a little bit of a different animal. So Apple had plenty of cash to well, their balance sheet, I think they're AA. They're AA or AA plus. They're not AAA. AAA is Microsoft. I know they are AAA plus. Not AAA plus, just AAA. And so Apple has a very good balance sheet. They're able to acquire debt at very favorable rates. And if you actually take a look back then at the yield of the shares versus the yield of the debt, well, the yield of the debt was less than the yield of the shares. So Apple actually was intelligent in that way, as in taking on debt, but they were in a peculiar situation. A lot of these other companies weren't in such a situation. And they had operations as such that what they were taking on was completely affordable. And so they just decided to take on the strategy, which was a good strategy, actually, and that is good execution of financial engineering, okay? So, but now let me change my tone there. In the more recent time, their execution of buybacks is going to be less effective than it was back then. So if I was the management team at Apple, I would be slowing that down now and just accumulating cash. Just accumulate the cash and wait for moments where my shares can be, again, undervalued and then begin the share repurchases. Because I think opportunistic buybacks by management team can be very powerful. They can be extremely powerful. Like, let me just say that right now, because Buffett's talked extensively about this, and I agree with Buffett on this completely, wholeheartedly, that buybacks, when they're well executed, when companies can cannibalize their shares, can be very fruitful for the investor base, okay? Because in that sense, when you get that high yield return on those shares, when you repurchase them when the yield is really high, then you can actually very much increase the future economic value of the remaining shareholders. But if you buy when it's at a low yield, right? Even like when you look at real estate, low cap rate, low yield on shares, low yield on real estate, that's not an opportune moment to really buy. There's a lot of risk implicit in that. And if, for example, you purchase all the shares right then and there, and 5 months later the shares are down, that is an opportunity cost that you do have to measure. That, in essence, is another way which we can evaluate the effectiveness of the buybacks and the potential loss that we realized. Because if the company had waited a little bit more and waited for more reasonable valuations, and this is where there's going to be another asterisk of subjectivity, because this is subjective in nature. What is a good value for a share? Well, it depends. And remember, couple that with what I just stated, that if the company has nowhere else to invest and it has very low, cheap capital disposable to it via the form of debt relative to its shares, then in that sense, management can make a very good case as to take on debt to buy that back the shares, okay? Because if I have nothing else to invest in, but my shares are yielding 5% and I can borrow at 2%, I should borrow that money at 2% at a fixed rate, 2%, and buy back my shares that are yielding 5%. If I somehow believe and I'm very confident that the company, if not, will stay the same or if not grow into the future in terms of its profitability, okay? In this instance, Apple executed on that measure as very well, okay? So again, that's I think several things for you to really think about when judging buybacks. There's a lot to think about. And if you actually take a look at Apple back in the day, Apple's debt has been rising steadily, but actually, if we take a look at the cash flows from operations, you can see that their cash flows are also rising steadily, rising nicely here. Okay, so In that case, right, when we take a look at it like that, Apple can't afford to do what it is that they're doing. They're not in a situation like Intel or IBM or General Electric, okay? But if they were to have continued to do this and just buy back tons of shares at these elevated prices, my tone would change, okay? My tone would change drastically. So I think that if the share price comes down, well, I think that in a way, we're getting lucky, or the shareholders of Apple are getting lucky, because when they're executing these buybacks routinely, you want the share price to be repressed, because in that case, the buybacks will be more and more effective. If you don't want the share price to actually rise when they're doing the buybacks, because but management teams sometimes like to blindly buy back shares, and that's unfortunate, because then that is how you can destroy shareholder wealth. So in conclusion, Tesla does not necessarily has announced this buyback yet. They haven't announced it yet, but if they do, then I will say right now, right here, right now, that it will be a poorly executed buyback. It would be a destruction of shareholder value, and instead what the company should focus on doing is issuing more and more shares right now so that they can put themselves in a position where their competition can't really catch up to them in the form of capital raise. They are in a position where something like Ford cannot do what it is that they're doing. If Ford were to issue, Ford has to issue 10% of their market cap to get around, and let me confirm this because I forget what Ford's market cap's at. Yeah, 10% to get about $5 billion. If they were to do it right now, okay, or over the course of this month, and let's say all else being equal, it stays at $50 billion. Tesla can do that with less than 1% of their shares outstanding. So then Ford has a problem there, because a competitor like Tesla, as long as the market is valuating Tesla at these levels, then Tesla has a cheap access to capital in the form of shares, okay? And this is really good. This is, again, why when we talk about REITs, and I've been asked this on the live streams, and I'll just mention it very briefly again. This is why REITs benefit from their high share price. It's a self-fulfilling prophecy. As the share price is higher, or the yield on the shares are low, they're able to issue shares and purchase more or greater abundance of properties, because they can afford lower cap rates and then still be accretive. So it's all about the difference between your cost of capital and what the project is that you're engaging in. All right. On that note, guys, thank you guys so much for watching. And now you guys know how to destroy shareholder wealth. If you guys are ever going to become a CFO, CEO, or on the board of directors of a company, now you know how to do it. So yeah, have fun doing it. All right. Have a good one. Bye.